Welcome to the Tax Breaks Podcast. I'm your host, Kelly Phillips Erb. I'm a senior writer with Forbes, and you might have seen me around the web as Tax Girl. I'm also a tax attorney, and I work with tax professionals and taxpayers like you every day. There's a lot to talk about, so let's get started. This week, we're talking about a not-so-usual open to the 2025 tax filing season. Plus, President Trump signs executive orders that could impact your taxes, beneficial ownership information or BOI reporting updates, child support and taxes, tax season statistics, industry updates, and more. The tax season opens on Monday, January 27, 2025. That's the first day the IRS accepts tax returns for 2024. But the IRS News website, normally a flurry of activity and the run-up to the open, hasn't been updated in over a week. It's clear that things are changing at the IRS and that this tax season could be very different and difficult. And yes, I realize that this is the exact opposite of what I've been saying. I didn't think there would be any immediate impact on the tax filing season following the change from the Biden to the Trump administration. Sure, we knew there would be a change in tax policy, including a likely pullback in enforcement efforts, but I didn't expect any real changes that would impact this tax season. I was wrong. As a refresher, late last week, now former IRS Commissioner Danny Werfel announced that his last day at the agency would be Monday, January 20th, 2025. In his first week in office, Trump officially nominated former Congressman Billy Long, who has no training in tax, accounting, or law, to take his place. While taxpayers await the outcome of Long's confirmation hearing, Deputy IRS Commissioner Douglas O'Donnell has stepped in as acting commissioner. O'Donnell has served as deputy commissioner since early 2024. Normally, we would expect to see some sort of welcome or other introductory message from O'Donnell, but that hasn't happened yet. It may be that the IRS was a little distracted. President Trump signed dozens of executive actions on his first day in office, including some that will impact the IRS and your taxes. One of those executive orders requires federal employees to return to work as soon as practicable on a full-time basis. The federal government is the nation's largest employer, with over 2 million civilian employees. The IRS has about 83,000 of these jobs. The move to force a return to office could send federal workers, including IRS employees, scurrying for the door. Trump also issued an order freezing hiring for most federal agencies. The hiring freeze does not apply to the military or immigration enforcement, national security, or public safety. The freeze is intended to be temporary, except for the IRS. Under the executive order, within 90 days, the Director of Office of Management and Budget, OMB, in consultation with the Office of Personnel Management and the new Office of DOGE, must submit a plan to reduce the size of the government's workforce. Once the plan is submitted, the freeze will expire for all agencies other than the IRS. With respect to the IRS, the hiring freeze will remain in place until the Secretary of the Treasury, in consultation with OMB and DOGE, determines that it is in the national interest to lift the freeze. Before the announcement, the IRS had been actively hiring, with extra funding from the Inflation Reduction Act, which Democrats passed under Biden and Republicans have never liked. With the IRS planning to open tax season on the 27th, a hiring freeze could have an immediate impact. Taxpayers may feel the pinch. With reduced staff, tax returns could take longer to process, and taxpayers may have to wait longer to see their refunds. Trump also signed measures aimed at foreign policy and taxes. One presidential memorandum calls for implementing an America First trade policy. In this much lengthier directive, Trump directs his advisors to take action to establish a robust and reinvigorated trade policy. Among other things, this includes directing the Secretary of the Treasury to investigate the causes of trade deficits, recommend some solutions, and examine the creation of a new agency, the External Revenue Service, or ERS. The ERS would collect tariffs, duties, and other foreign trade-related revenues. The memorandum also requires the Secretary of the Treasury to investigate whether any foreign country subjects U.S. citizens or corporations to discriminatory or extraterritorial taxes. If so, Section 891 of the Code allows the President to double U.S. tax rates due by citizens and corporations of those countries, subject to certain thresholds. As an aside, the rule has been in place since 1934, but never been used. Trump also directed members of his administration to notify the Organization for Economic Cooperation and Development, called the OECD, that any commitments made by the prior administration related to the global tax deal were no longer valid. Here's what he's referring to. The OECD, which includes the United States, is made up of 38 member countries. It believes that the current tax system gives multinational companies, those that can easily move their operations and properties across borders, an unfair advantage over domestic businesses. The OECD also believes that when taxpayers see those multinational corporations avoiding paying taxes, even if it's done legally, it undermines all voluntary compliance. For years, these challenges have been broken down into two sets of talking points, referred to as Pillars 1 and 2. Pillar 1 focuses on where tax should be paid. As part of the Pillar 1 agreement, large multinational companies must pay taxes in the countries where they operate, not just where they have their headquarters. This would prevent companies from opening headquarters in low-tax countries simply to shift profits. Pillar 2 examines the amount of tax to be paid. The Pillar 2 agreement would establish a global minimum corporate tax rate of 15%. The current corporate tax rate in the U.S. is 21%. In contrast, Ireland's corporate tax rate, where many U.S. companies like Apple had previously established headquarters, is just 12.5%. Today, 140 countries have reached agreement on these issues, and until recently, that included the United States. Despite Trump's order, there's no immediate change here, but it does signal a shift in U.S. sentiment. Since the U.S. is a big player in the global economic scene, this could cause a real problem for the OECD and for U.S. foreign relations moving forward. Finally, an additional executive order declared the end of birthright citizenship in circumstances where an individual is born within the U.S., but neither of the parents are lawful permanent residents or U.S. citizens. That order has far-reaching implications, including from a tax and estate planning perspective, since the tax code's treatment of U.S. citizens and permanent residents versus non-U.S. citizens and non-permanent residents is quite different. Legal challenges have already been filed to halt implementation, but you can bet that tax and estate planners will be watching this one closely. If that feels like a lot of news, you're right. But at the end of the week, advisors and businesses got even more news. The Supreme Court has ruled, for now, on the Corporate Transparency Act, or CTA, granting the government's application for a stay of a Texas ruling that had blocked the beneficial ownership interest, or BOI, reporting requirements. BOI reporting is the result of a 2021 law called the Corporate Transparency Act, or CTA, that requires companies to file reports that identify a company's beneficial owners with FinCEN, the Financial Crimes Enforcement Network. A good rule of thumb? A company must report if it was created in the U.S. by filing a document with the Secretary of State or similar office. Or, if it's a foreign company, it is registered to do business with the state or similar office. There are several exemptions, 23 to be exact. Businesses that did not have to report include publicly traded companies, charitable corporations registered with the IRS, and certain large operating companies. But that wasn't all. While the High Court was considering the request, another Texas court got into the act with a different result. On January 7, 2025, a U.S. district judge in Texas granted a preliminary injunction and stay that would prohibit FinCEN from enforcing the new law. In that case, Smith v. U.S., Judge Jeremy D. Kernodle enjoined the government from enforcing the CTA not only against the plaintiffs and their related entities while the lawsuit continued, but it was a little bigger than that. The injunction purports to apply nationwide. In Smith, the plaintiffs made for a stay, there's that word again, of the reporting rule. Judge Kernodle granted that motion, staying, meaning temporarily stopping, the effective date of the BOI reporting requirements while the lawsuit is pending. FinCEN acknowledged the Smith ruling on Friday, posting on its website that a separate nationwide order issued by a different federal judge in Texas remains in place, which means that reporting companies are not currently required to file beneficial ownership information with FinCEN despite the Supreme Court's action in Texas' Top Cop Shop. Bottom line, the legal drama continues, but businesses don't need to rush to file just yet. Just before that ruling, an episode of Tax Notes Talk, the Tax Notes podcast, focused on where the CTA stands in light of recent litigation regarding its constitutionality. You can read the transcript of that episode on the Forbes.com Tax Notes blog. Speaking of podcasts, this is the first official episode of the Tax Breaks Podcast. It features the tax news and information you've come to expect from our Tax Breaks newsletter, plus some special guests and value-added features. I'm excited about what the season holds and glad that you've chosen to join us. Now, let's answer a taxpayer question. This week, a taxpayer asks, how do I claim voluntary child support I've paid on my taxes? Here's my answer. Child support payments are tax neutral. That means there are no federal income tax consequences for making or receiving child support payments, no tax deduction for paying child support, and no reportable income for receiving child support. Alimony, however, is a bit different. For decades, alimony was tax deductible. However, due to 2017 tax reform, alimony is no longer tax deductible for agreements and orders signed on or after January 1st, 2019. That also means it will not be taxable to the recipient. If you have an older agreement, the tax treatment stays as is unless you modify the agreement after January 1, 2019 by explicitly referencing that 2017 law. If you have a tax question or matter that you think we should cover in the next episode, let us know. You'll find more information in the show notes. Of course, if you follow me on Forbes, you know that I love looking at statistics and enjoy a good chart or map. This week, I'm focusing on filing statistics for the first week of the tax season. As I mentioned, the tax season will open on January 27, 2025. That date marks when the IRS will begin accepting paper and electronic tax returns. The agency expects more than 140 million individual tax returns to be filed by tax day, April 15, 2025. Last year, the IRS received 15,318,000 individual tax returns in the first week of processing, but that was nearly a 20% drop from the same time period in the previous year. You can see what the opening tax season week has looked like year over year in the chart. You'll notice that 2021 was something of an anomaly. Due to the pandemic, the IRS tax filing season opened later than usual, so taxpayers who had hoped to file early had to hold on to their tax returns. I'll be following and sharing the filing stats for 2025, including average refund amounts and e-filed returns throughout the season. Now it's time for a deeper dive. This time, it's a look at final regulations focused on tax implications for U.S. persons receiving certain gifts and bequests from former U.S. citizens and long-term resident green card holders. 17 years after Congress enacted Section 2801 of the tax code, the IRS has finally released those final regs. The regulations clarify, to a certain extent, that the tax implications for U.S. persons receiving certain gifts and bequests from former U.S. citizens and long-term resident green card holders are as follows. Section 2801 imposes a transfer tax, currently at the rate of 40%, on the value of covered gifts and covered bequests received by U.S. persons, citizens or residents from covered expatriates. Covered expatriates are individuals who meet certain criteria and who renounce U.S. citizenship or abandon long-term resident status. For green card holders, a tax expatriation can happen inadvertently when challenged at the border about meeting requirements for continued U.S. permanent residence. If a U.S. citizen or resident received a gift or bequest from a foreign person after June 17, 2008, they may be required to file Form 708 and pay the Section 2801 transfer tax. If that sounds unfamiliar, it's because it's a new form. The IRS has not yet made Form 708 available. Determining whether the transfer is subject to the transfer tax falls on the U.S. recipient. With that in mind, U.S. persons receiving gifts or inheritances from foreign persons should consult with tax professionals to navigate these rules. Failure to plan properly could result in unintended tax burdens. Now for something a little more brief, some quick accounting and tax newsmakers. First, private equity continues to make inroads in tax and accounting. Recently, Inflection, a European mid-market private equity firm, announced that it has agreed on a minority investment in Baker Tilly Netherlands, a leading accountancy and advisory firm. The investment is being made by Partnership Capital III, Inflection's dedicated minority fund. Also in trends, a new trend could be brewing. The accounting firm KPMG hopes to expand into legal services. KPMG Law US, a subsidiary of KPMG US, applied to the Arizona Supreme Court to operate as an alternative business structure. Arizona is the first state in the country to do away with rules barring non-lawyers from co-owning law firms. And we know that the accounting profession has its share of challenges, but according to the Global Economic Conditions Survey, the largest regular economic survey of accountants worldwide, confidence among accountants and chief financial officers, or CFOs, has fallen sharply. The survey, which is carried out jointly by the Association of Chartered Certified Accountants and the Institute of Management Accountants, surveyed over 1,800 accountancy and finance professionals. The confidence level is now at its lowest since the second quarter of 2020. Finally, the Mississippi House of Representatives passed House Bill 1, which phases out the state income tax over a decade. The bill now goes to the Senate for consideration. Pay attention to this one. If federal support for states is reduced, I'd expect measures like this one to fail. And now, a little tax trivia. In what year did the IRS first accept e-filed returns? Your choices are A, 1981, B, 1986, C, 1992, or D, 1997? I'll give you a minute. The answer is B. In 1986, an IRS pilot program accepted 25,000 e-filed tax returns. Only 5 tax preparers in 3 metropolitan areas, Cincinnati, Raleigh-Durham, and Phoenix, agreed to participate. At the time, the system could only process returns that were due refunds. By 2011, 100 million returns were e-filed in one filing season, with a cumulative total exceeding 1 billion returns. That year, approximately 3 out of every 4 individual tax returns were filed electronically. Now, it seems like we all do, but back in the day, it was a little bit different. And that's a wrap for this week. I'd love to know what you thought of this episode. You can send an email with your feedback to me at kerb, Kerb, at Forbes.com. And if you liked it, please share. You can find a link to the audio of each episode on Forbes.com. You can also subscribe at Apple Podcasts, Stitcher, Spotify, or your favorite listening app so you never miss an episode. Thanks for listening, because paying taxes is painful, but hearing about them shouldn't have to be.